You might have heard about the CMHC MLI Select, which is a relatively new commercial mortgage that can give better financing terms. And with all of the hype surrounding it, we're getting more and more questions asking us what the upsides and downsides of investing in commercial residential real estate are. Well, it's not only the financing difference, but there are also other risk factors, and the returns can vary too. So in this video, we're going to break it all down for you. If you're new here, we're all about helping you make better real estate investing decisions in Toronto. Don't forget to like and subscribe if you enjoy our content. Let's dive in. Let's start by diving into the financing aspect because this is definitely our top question. Well, traditionally, commercial mortgages didn't have the same appeal as residential properties because the financing options were just not that great. They had lower loan-to-value ratios and the lenders often charged higher rates. But then enter the CMHC MLI Select. And once this program was introduced, suddenly you're looking at potentially snagging financing terms that are way better with an improved 95% loan to value ratio, better interest rates, and up to a 50-year amortization, which ends up looking a lot more attractive compared to a typical residential mortgage capped at an 80% loan to value ratio for investment properties. But to be fair, let's not overlook the fact that if you are considering residential properties, there are CMHC financing options here, and you can potentially get financing with up to a 95% loan to value ratio here too. But this percentage varies depending on how much you borrow, and you have to live in part of the home yourself. Now, before I move on from here, I do want to touch on something else that can trip up new investors, and that is that there is a key distinction between the type of property, commercial, residential, or residential, and how you structure the purchase. Now, how you structure your purchase, whether it's through a corporation or your personal name, determines what your liability looks like, your government penalties, your privacy, and things related to tax planning. But your property type, whether it's commercial or residential, dictates the type of mortgage and your financing terms, so I really wanted to clear this up. Now, moving on, let's break down how the type of mortgage you choose can impact valuations and how much you can borrow. Now, these are critical factors if you're aiming to refinance and expand your real estate portfolio. Here's the thing, when it comes to residential properties, there's more market noise here. You've got end user properties being bought and sold based solely on emotions, and the property's value is largely determined by an appraiser looking at market comparables. And if your property is more unique, it would be tougher to get an accurate valuation without seeing an actual transaction. So valuations on residential properties are definitely a lot more subjective and susceptible to big market swings. Now, with a commercial mortgage, the amount that you can borrow hinges on the rents that you are able to get. And if your rental income is strong enough to cover your mortgage payments and operating expenses, plus a little bit of a buffer, you're in a position to secure a much larger mortgage capped at that 95% of the property's value in the case of the MLI Select. And this value is also calculated based on math using market caps. So with commercial mortgages, valuations are definitely a lot more predictable, which is honestly one of the biggest pluses for commercial mortgages. Now, from a return standpoint, I would say that they are different as well, commercial versus residential, but it is harder to say for sure that one is better than the other. From a rent yield standpoint, commercial properties can have better cap rates than a smaller multiplex if you do build from scratch. But if you do buy a single family home that's big enough, which then can be converted into multiple units under 5 units, that's still residential, there is still a potential to hit great cap rates here too. Now, in terms of market appreciation, commercial properties tend to be more stable here because buyers and sellers are driven more so by numbers. However, because commercial properties also cost more, they also don't see the same amount of demand as residential homes, and history does tell us that properties that are at higher price points, like commercial properties, do lag a bit in terms of appreciation. But at the end of the day, real estate in the same area do tend to move together in line with each other. So commercial properties can never fall behind too much, especially when values are tied to market cap rates. All right, let's talk about value add too. When you're jumping into a bigger commercial project, you are investing more here, and so this does give you the potential for much bigger gains. However, smaller residential projects can also deliver pretty solid ROI, even though the absolute gains won't be the same. Now, here are a couple other things to keep in mind. Right now, with the government's focus on the missing middle, smaller builds here do get a big break on development charges, which are waived for the first 4 units in a multiplex. But when we look at building apartments, DCs run around $50,000 per unit here, which can add a lot to your build costs. Then there are also GST rebates on the build. Here, commercial properties do get the full federal GST rebate, while smaller builds here get a partial rebate. So again, pros and cons for each of them. So if we were to sum it all up, let's try to look more objectively at the big picture, balancing risk and return on investment for both. With conventional financing, it is possible to hit the same ROI for both types of projects. Add that to the fact that smaller residential projects need less capital and less time. We are leaning towards residential projects for newer investors to build up your experience first. Then, as you gain experience, transitioning to CMHC MLI approved projects can eventually look more attractive. It all comes down to refinancing terms, which can drastically help you cash out more money faster and improve your stabilized return on investment. But honestly, it is pretty tough to miss the mark when it comes to investing in multi-unit residential real estate in Toronto, whether you have a commercial residential property or even just a smaller residential property. You have solid potential for long-term real estate gains either way you go. But if you are wondering which one might be better for you, our team is here to help. We're not your typical real estate sales brokerage. Instead, we focus on using numbers to make better real estate investing decisions in Toronto. And that can mean looking for stronger investments with positive cash flow, thinking about risk management, and looking for ways to boost returns like value-add renovations and gentrifying areas. So if you do want to discuss your private real estate situation with us, just head over to this link here to set up a time to chat. You can also check out more content on our website or find us on social media. And if you haven't done so already, please like, subscribe, and share this video if you think someone else might like it too. Thanks so much for watching, and I'll see you in the next video. Bye.